Normally, when I make investments in the fund, I don't, in fact, I've never invested more than 10% of assets in any one bet. Typically, ideally, it's kind of a 10 by 10 portfolio. There was a very good investor in India who passed away recently, Rakesh Jhunjhunwala, and he never managed money, outside money, and he had probably less than $500 to his name when he started his career. Didn't live that long, actually died in his early 60s. And when he passed away, his net worth was north of 6 or 7 billion. No fees. These are all, organic. And he didn't run companies. These are all, passive investments. Half that money was from one company. So he made a 4% bet a few decades ago in a company called Titan Industries in India, which ended up becoming more than half his portfolio. And Titan has done extremely well over the years, going to keep doing well. So if you think of someone like Rakesh's portfolio, let's say the other 96% of the portfolio went to zero. He just hung on to his Titan. Well, he still end up with like 3 billion or something. And so we start out, I would say, not that concentrated. But if the job is done right, you would end up very concentrated. So one of the things I always kind of scratch my head about is that, these very smart investors would buy MasterCard after the IPO. And, they might be more diversified than me. Maybe they might have 20 positions, which is fine, no problem. And so MasterCard is like a 5% position. And then it does really well and it becomes a 25% position or a 30% position because it's done so much better than everything else. Like Jack Nicholson said, they can't handle the truth. And in some cases, their grandmothers took away certain body parts when they were 13. So, they're done. Well, it gets to 15% and they trim. It gets to 17, they trim again. And it never gets to even 20%, right? And to me, I really scratch my head about that. So, yes, you get a diversified portfolio, but you're cutting the flowers and watering the weeds. And that's not what Rakesh Jhunjhunwala did, and that's not what Warren Buffett did. I think if an investment manager has done the job right, they're going to end up with 80-90% of the net worth in one stock. And the way they should think about that stock. So if we think about the Walton family and their ownership of Walmart, Sam Walton passed away a long time ago. There are no Waltons running Walmart. There might be a couple of them on the board, but they really don't have much influence about the way Walmart runs. But almost all the Waltons are extremely concentrated with 90% or more of their wealth in just one stock, right? So you don't need to be a founder or a founding family to have that concentration. So my friend Nick Sleep, for example, hung up his boots. He had 3 stocks. And one stock, Amazon, became 80%. Because it did so well and the other 2 weren't slouches, but it did better than Berkshire and Costco. And the way to think about Amazon 80% is the way the Walton family thinks about Walmart stock when it's 80 or 90%, which is you are effectively like the founding family and it's a great business and you just leave it alone. But this is hard. This is hard for most people to do. And I think I have a lot of respect for Rakesh because of what he was able to do on that front.
One of my painful episodes is that I owned one of those called Crizzle. I had met Mohnish maybe once, not even, and I go to India for the first time. I remember, Mohnish, you gave me the book by Dalrymple, City of Jinns, to read. I don't know if you know that because Jhunjhunwala was a significant shareholder of Crizzle. And so I went to his office to try and
Crizzle
meet
is
him.
Crizzle is like the Moody's of India.
Forgive me. This is it was the first stock. I've only owned, I think, 3 stocks in India. I was looking for credit rating agencies around the world, found Crizzle, bought shares in it, went to visit, made significant return on my investment, but then convinced myself that I not only had to trim the flowers, I pulled them out and threw them on the dustbin. And that would have had a very significant impact on my net worth and the net worth of my investors if I'd stuck with it. It's probably up 50 or 100 times since I sold it. But Mohnish, so I go visit Jhunjhunwala's office somewhere on that kind of peninsula that is Mumbai. And there's just, there's like there's place for 20 people there, and Jhunjhunwala's office is empty, and there's one guy, there's not a lock on the door even, it feels to me. I kind of just walk in, and there's a guy who looks at me and says, he wonders what I'm there for. That was it. That was his whole office. And just funny. Yeah, sorry, just a reminiscence.
Yeah, and the thing is that, we're old too soon and wise too late. There are so many great businesses that I sold, which I have a very deep regrets about. I had ownership of something like 1% of Ferrari in our funds. What could be better than that? And this idiot sold it. And the idiot's friend is smarter than him, and he's kept it, which is wonderful.
But only half as smart, because I sold half of it just as we went into lockdown. Mohnish doesn't let me forget that, by the way.
At least not the whole bunch of flowers were thrown away like me. At least you kept some of them. But the thing is that with some luck, I may have another 32 years or so on planet Earth. So there is still time to apply the lessons that took a few decades to learn. But I think one of the big lessons is that when you find yourself in the great position of fractional ownership of a great business, you don't really try to do things like cute things like figure out intrinsic value, etc. When in 1972, Buffett and Munger, they always say that they have a perspective on what the intrinsic value of Berkshire Hathaway is. And they say if both of them wrote down their numbers, they wouldn't be the same, but they would be in the ballpark. And I actually disagree with both of them. So, in the mid 70s, Berkshire stock was $40 a share, which is now over $400,000. It's a 10,000x. What was the intrinsic value of Berkshire in the early 70s? The answer is that it was a really large number. We don't know what that number was, but we know it was a very large number. Now you could calculate book value and you could give it some multiple on book value, but what you're not taking into account is what if this great compounder of capital is sitting at the helm of this company for 50 years after that? What happens then? I think in a lot of great businesses, we can get to liquidation value, we can get to floor values relatively easily. We really cannot get to intrinsic value, because if they keep going and you go 10, 20, 30 years, what does that look like? I have no idea what that looks like, but what you need to do is just stay on for the ride.